give us some insights as to what is happening in Europe. And I want to look at this through the lens of potentially a global recession,
Mhm.
and then how that would play out in the United States. Because right now, to your earlier point, everyone is saying, my gosh, the United States economy is booming. There is no recession. That's just complete fake news. All you have to do is look at the stock market and look at the unemployment rate. But
Mhm.
then I look at Japan, I look at the UK, I
Yeah.
look at Germany. I think just today or yesterday it was Finland that came out as well. Ireland is just getting crushed. I saw that. But a lot of these countries in the Eurozone
Yeah.
have come out, along with the UK, Germany, and Japan, and said, "Oh, by the way, guys, we are in a recession right now.
Mhm.
Not that we're forecasting one; we're in one." And then when you look at their unemployment rates, they're all very low.
Yeah.
You look at the stock markets; they're all at all-time highs.
Yeah.
So I'd like your thoughts on that. And then, can the United States avoid a recession
Mhm.
based on what we see all over the world, including China, where they're having the most deflation that they've had in decades?
Yeah. So bad news is good news until bad news is bad news, basically. That's how the market works, right? So bad news is good news because if it's bad but not bad enough, then ultimately it means that, you got to be cheery because central banks are going to come to the rescue. And so, it's bad news, but ultimately it's good news because central banks are coming.
Yeah.
That's how markets really think, right? And so I think in Europe we are in that situation right now. But let me take a step back and make the difference between these countries that you just mentioned. They're perfect examples, the UK or Europe and the United States. Okay. So why are we in this different economic cycle, really? And I think the answer is twofolds. So the United States economy has been relatively resilient to the increase in interest rates for a couple of reasons. The first one is that after the great financial crisis, because of the excessive private sector leverage entering the financial crisis in the US, people have been burned badly by the housing crisis in the US in 2008 and 2009. So they have realized that getting all that private sector leverage, having multiple mortgages without an income and so on and so forth, wasn't actually a great idea. And so what they did is they deleveraged. Okay, so they have reduced their private sector debt, and who's taken the baton of levering up in the United States has been the government. So the US government has expanded their deficit slowly but surely, injecting money into the private sector and basically making sure the private sector could deleverage a bit. Now, don't
Mm,
get me wrong. It's not like the US doesn't have any private debt anymore. It still does. But
right.
compared to the before 2007, the private sector in the US has a bit deleveraged.
Yeah.
Okay.
So they've got
So,
more balance sheet capacity.
correct. So, if interest rates are going up, but your private debt is not particularly large, it's going to have an impact, but it's going to have less of an impact than if you're highly leveraged on your balance sheet, right?
Right.
So the rise in interest rates has been having a bit less of an impact than it would have had, for example, in 2007. Point one. Point two, households in the US have been pretty smart, but also corporates. Like they've used this low interest rate period of 2017 to 2021 in the US to lock in low interest rates for a long period of time. So 30-year mortgages in the US were below 3%, and the mortgage production volumes were incredibly large, showing that people aren't stupid, George. And if you give them the opportunity to lock in nominal fiat borrowing at 3% or lower for 30 years, they will take it. They
Yep.
will take it. So corporates did the same, by the way, in the US. They locked in corporate borrowing. So they basically issued bonds or got loans for long periods of time, 10 years, 20 years, 30 years at low interest rates. Why do I mention that? When you raise interest rates as the Federal Reserve, your idea is to slow down the economy. And how do you slow it down is by saying, George, you have a mortgage. Next time you have to refinance your mortgage, your interest rates will be much higher. So you will then be on your 4K salary a month, you'll be forced to spend more money in that servicing. You'll spend less money in your consumer spending habits, and that will slow down the economy. For corporates, they'll do the same by saying your debt is much more expensive, so you'll have less capex, less investments, less hiring, because you'll have to focus more on servicing your debt. That's the mechanism that slows the economy. But what if corporates and households have instead locked in long interest rates at very low levels? What if they don't need urgently to refinance? Think
Right.
of mortgages. Like, what if they don't need to sell? What if they don't need to refinance? Does it matter if the new mortgage rate is 7%? Yes, it matters for the new buyer. Okay, so you see a frozen housing market, but does it hurt the existing homeowner? No, and unless he needs to sell, unless he's forced to sell, it doesn't, and to refinance, it doesn't really hurt him. So you gain time. If you lock in low interest rates for a long period of time, it takes longer until the rise in interest rates can negatively impact households and corporates.
Yep.
When the refinancing cycle kicks in, that's when you get hit, right? But it takes longer to kick in this time. That's what I'm trying to say. Additionally, the floating rate mortgages and the floating rate corporate bonds and loans as a share of total in the United States are very low, contrary to 2006, 2007. So most of the interest rate is fixed. If you raise interest rates, you're not going to pass through the cost immediately to mortgage owners because it's a fixed interest rate, not a floating interest rate. So once fixed, it's always fixed. Now, you see these three components: the low share of floating rate mortgages and floating rate corporate issuance, a bit of deleveraging that has happened in the United States, right? And the, let's say, the maturity of this private sector debt that has been prolonged very smartly by the private sector in the US before the increase in interest rates. Take that and try to apply this to Europe.
Yeah, it's the
And
opposite.
you will see that not a lot works. So, for example, in Italy or in Spain, 45% of the mortgages are on a floating rate basis, which means the ECB hikes rate. I am an Italian. I feel it now. I don't have to wait. You know, my mortgage expenses go up immediately. My salary as an Italian hasn't gone up for 30 years, I guess, in real terms. So that means I have the same amount of disposable income at the beginning of the month, but I have to pay much more in mortgage interest costs now, George.
Right.
I can't wait. It's now. It's hitting me now. Second, in certain European countries, and that is particularly true for the Northern Europe, surprisingly for many, the north part of Europe is much more indebted on a private sector debt than the southern part of Europe is. So Finland, that you just mentioned, the Netherlands, Sweden, Norway, Denmark, all these countries have a very high private sector debt as a percentage of GDP. Okay, so the opposite of what I said to the US is true. While the US has deleveraged, so the private sector debt has gone down a little bit, North Europe hasn't deleveraged. There's actually leveraged their private sector from the great financial crisis. So there is more debt, basically, that is charged more through floating interest rates, and cherry on top, the refinancing cycle in Europe is much more imminent than it is in the US. And
Right.
why? And why? In 2015-16 in Europe, we had negative interest rates, a beautiful phenomenon where you are paid to borrow. Okay, that's amazing. So a couple of corporates said, that's great. I'm going to issue as many bonds as I can. And that was the case in 2016 and 2017. The average tenor of these European corporate bonds is 7 years. So now you make the math, 2017 plus 7 equals 2024, which
Right.
means that all the freaking bonds are coming due now for refinancing, and
Right.
corporate borrowing rates in Europe have gone up from 1.5% to 5%.
Oh my
So
gosh.
if you were a corporate, every business model in Europe works because corporate borrowing rates were so low. You know, every business model works if you borrow at nothing percent. Now try to borrow at 5, and a few of them don't work. The same goes for the UK. Similar setup. Sweden, same story. And that explains why these countries are running at a GDP of 0% already for 12 months, right? It explains why the passage and the tightening of monetary policy gets through much more quickly and intensely than it gets through in the United States.
That's a great explanation. So then the question becomes, can the United States avoid that? Because as you're describing the United States, obviously that isn't even an opinion. You're just stating fact. But it is true that while someone has a 30-year fixed rate mortgage, they also have other costs that are associated with that house, such as insurance, such as property taxes, such as maintenance. So if their real incomes are actually going down, even though their nominal incomes are going down, they could be still forced into a position where they have to sell that house. Although, to your point, it may take a lot longer. Same thing with the corporates. You know, if they've got to pay people higher and higher and higher wages, that's going to decrease their margins. That's less money that they can allocate to a higher interest rate when they have to roll that over.
Yeah. Look, the key to the house of the macro conditions in the US is in the labor market, George. Like, if you get some cracks showing up in the labor market, so the moment that companies don't hoard labor as aggressively as today, because companies are not hiring aggressively. If you look under the hood and you look at full-time hiring, if you look at not the part-time, the multiple job holders, I'm talking about full-time hiring from United States corporates, you will see it's pretty slow today, very, very close to 0% on a year-on-year basis. Additionally, you will also see that it's true that people are not, that companies are not firing actively. That's also true. So layoffs are very low at the moment, but also it's true that people aren't quitting their jobs anymore. So the job market has cooled down. People feel it. They're not quitting their jobs. They're not taking any risks anymore. But at the moment, it's a frozen job market. So companies aren't hiring aggressively. They aren't firing either. People aren't quitting jobs. It's like, you know, a stasis in the labor market, a bit like it is in the housing market to a certain extent. And we need to figure out, how do we solve that fragile equilibrium, right? And look, if the Federal Reserve would start cutting interest rates proactively, okay, right now, they would probably have some, you know, insurance towards a bad resolution of this fragile equilibrium, because maybe they cut interest rates and companies feel more comfortable in hiring again, and so on and so forth. But the Fed is afraid. The Fed is afraid of making the mistakes of the 1970s, George. You know, they're there and they're watching this inflation come down, and they're not sure, should we go for it? Should we wait a bit longer? The longer you wait at tight financing conditions, tight credit conditions, at tight interest rates, the longer you wait, the more you increase the chances that this fragile equilibrium sorts itself on the bad outcome, not on the good outcome. So the Fed here is called to make a difficult decision, I think. Some people say, oh, look, the annualized core PCE, which is the measure they target on inflation, is already at 2%. It was 1.6 at some point if you took the 3-month or the 6-month annualized rate. But then you get the January print and you get a pickup in inflation, and it looks like 2.5% now. So if you are in the Fed, it's a decision of trying to proactively ensure the good outcome, but taking a risk on inflation, or keeping policy tight for long and taking a risk that, you know, you tweak the scale towards a bad resolution of this fragile equilibrium. I think Powell wants to wait. I think he wants to be conservative. He wants to make sure that inflation is going to 2%. So he's taking a risk that the bad outcome actually realizes.